Well, good day, everyone. It is spot on time, 12:30 for this punchy 15-minute show. I hope you are enjoying the structure that we have for the show presently. I have switched on my video, but it's not showing, so don't worry about that. So what we're looking at today is Hang Seng 50 price action of a couple of days ago, yesterday actually, overlapped into day before. Now, one of the key things that I am always mentioning to price action traders, when you're trading the 5-minute chart and you are trading the open, it is absolutely imperative that you have a look at the US session and see what has transpired for you in the US session, because the US session will give you key levels that you ought to take into account and bear in mind as you start to trade. So this level here, key session from the US session, as market opened with a gap up. So that dotted purple line was the close of yesterday. The market opened there, gap up, plus bull candle, first candle. Now that's a first candle trade. When you come to the course that I hold for trading the open, and if you are a beginning trader, and beginning traders, it's, you know, we've all been there, been beginning traders. I don't recommend you take first candle trades. So I just say ignore first candle trades, wait for second or third candle trades. But that's a classic for the guys who come to the year-long session, you know, the coaching session we talk about. It's a bit of an advanced thing how to interpret it, but everything tick the boxes here. Gap up, big thin. The gap was closed at the open. And then, so it became a beautiful low test, candle clearing a lot of previous levels. So you can take that trade. Trick, of course, with every trade at the open, first, second, third candle trade is your measure move stop. So you'd have looked at the high of that candle, measure move stop. You always do that because the market might just turn and take you out. So you don't want to get taken out because you've decided to put a tight stop when you shouldn't have put a tight stop in the market. Okay. Bull entry for double bottom after wedge bottom, key. So the US session is absolutely key. It's given us a lot of information. It's given us a key level. It's also clearly told us that towards the end of the US session, a wedge bottom was created. Now, a wedge bottom is a reversal pattern. Once you see the wedge bottom, you have to wait for high, low, double bottom, or something else, lower, low, double bottom, some kind of signal to jump into the market. So as the market closed yesterday, there was a signal, and the market was waiting for that to be triggered at the open, so it could trigger. If you had taken this trade yesterday, you'd of course put a measured move stop of the trading range, which corresponds to our first candle. So good trade to take. Then we have a bull candle, second candle, bull high test. So, market went up to test that, bull high test, bull doji, second candle. So if you haven't taken that trade, whenever you see a doji, you must wait for a breakout pullback, because a doji is trading range and most trading ranges fail. So you want to have to wait for that. We had a bull third candle, try to break out above that. Now, quick one, in terms of second candle trade that we speak about in the course is, if we were to take as a second candle trade after the open, the market will come back, or the bears will try and make the bull breakout fail, but not take out the low of the first candle. So if we did that and they came back and we had the low test candle, which was an inside candle, then we'll take a second candle trade. But we didn't have that, so there's no second candle trade. Third candle trade is usually a breakout pullback, and then you take that, but that we're not taking that because of the doji. Then we have a fourth candle, bull doji, 1, 2, 3, 4. There's a fourth candle, bull doji, key candle to look out for. Why would the fourth candle be a key candle to look out for on the 5-minute chart? At the Hang Seng Open, the 5-minute chart traders are kicking off the trading. Then we start to get, the other traders coming in. At the 15-minute mark, traders come in. At the 30-minute mark, traders come in at the hourly. So that 15-minute candle is absolutely important. We created a doji, clearly indicating to us that a breakout is likely to fail because a doji is a trading range, one by trading range, likely to fail. So what would you do in that particular case if you are in this trade? If you are in this trade, seen a doji, this is a time when you just pull up your stop and put the stop beneath the dojis. Okay, that's beneath the trading range. Then it's going to be break-even bull breakout, nothing for us to trade when we see that failed breakout. So the bulls tested the key US session, and beautiful. I mean, as beautiful as they come, reversal signals. When you're expecting the market to turn at some point, indicate that reversal signal. Then if you are in the longs, you must get out. If you're not in the longs, because you've seen all of this taking place, that is a trade to take. And of course, when you take that trade, you need a measured move stop out there. Why would you take that reversal signal? Failed breakout above the measured move of the first candle. There is the first candle. That tested it, that's a breakout failed. Failed breakout above that US session level. This is enough reversal candle. You gotta take that trade. If you didn't take that trade, huge acceleration down by the bears, which is fantastic for the bull case. For the bear case, then you cannot take that trade. Now, I don't trade breakouts. I wait for a confirmed breakout. So, if one of the guys are looking at price action with me, you might say, hey, George, hang on a second. You don't take trade breakouts, buddy. So why are you taking that trade? Well, something that we talk about in the year-long course, there is a reversal within this tail. Okay, breakout, pullback, low one, big bear breakout. There is a pullback, low one is a resumption of the bear trend. It's invisible, but it's in the tails because at some point market will end up coming back. So when you're selling here, you are selling the low one. Stop a little bit tighter, so you can take that trade. And then, hope that the bears are strong and you get huge acceleration down. Now, something to mention about the structure of the market yesterday. There was Chinese news on this candle, the GDP for the quarter and the year. So if you are taking a trade here, you are trading into the news. You have to make a decision. Do I take this trade ahead of the news or do I stand back? Okay, I always recommend for the guys, it is absolutely the easiest thing to do, and highly recommend it not to trade into the news. So if you're taking that trade, maybe you can hold that at a measured move above there. That's your first. If you're taking that becomes your second trade. That's your first trade. It's 0.25%. Like I recommend. Measure move stop, you could do that. But if you take that trade and your stop is there, you must be psychologically prepared to get stopped out because anything can happen after the news. So you may wonder what caused this reaction. Well, it was just the market responding to the Chinese news. Bull breakout above low of yesterday. So that made this a failed breakout. And also at the same time, it tested the midpoint of the range of yesterday. So that dotted line is 50% midpoint in the range of yesterday. But immediately after that, you said, hey, bulls are so strong. Look at that, they reversed the market below this level. Now, this level is absolutely key, even if you look at what's happening today. On the daily chart, the market created in January a bull breakout, two candles, first two candles of the year, and a channel. So it's a bull spike and channel trend. This low here, this blue line here is the low of the bull channel on the daily. So a very significant level of resistance and support, hence all this reaction around it, which is kind of carried on through into today. So there was a failed breakout beneath it by the bears. We didn't get the follow through. Bulls reversed it. But look at the bulls. In spite of the strength, created a doji. Immediately, there is a problem with the strength of the bulls, because if they were strong, they would have given us a follow-through candle. Then we can start to think about pullback. So doji, again, if you get a breakout, measured move is probably around there. If you get a breakout beneath here, measured move brings us down to this level. Then we're coming back into the low of yesterday. And what we have here is a lower high double top. So market came back. So we have to wait. You can't trade beneath a bull doji. You can trade anyway. And I have to remind myself, you can trade anyway. If you are a scalper, just sell. Whenever you see a bear candle, you can trade anyway, but you gotta know where your stop is. I prefer to wait for clarity in terms of the signals. Okay, so beneath a doji, I'm expecting that the breakout will fail. So there is a breakout and it fails as expected down here. Breakout, pull back, the market resumes again. So that's a low one. Unlike this one, which was a breakout, pull back, and the low one was invisible in the tails. This one, the breakout, pullback, low one. We're at the low of yesterday. Need a little bit more clarity that the bears are taking over, which you get by another breakout, pullback, and a low two. Call that breakout, pullback, low two. So the second attempt, by the bears to take the market lower. So that is a trade that you're going to take. Then when you're taking that, you've got to be cautious. You're going into that 1 hour close for the market. So I would just take my profits or even break even and not worry about it. At the open, market carried on selling. Now, you don't want to look at this and say, hang on, market, next time I get to the close of the market, I'm just going to hold on to my trades in case I sell off. The open is just like red news. You have no idea what's going to happen. Take your profits. Or if you've got a wide stop somewhere up here, then you can take your chances. Wedge bottom, 3 attempts by the bears to go down, repulsed by the bulls. Failed breakout beneath the wedge bottom, another reversing signal. We had one here. The problem with this one is that it's a bear candle, so you need to wait, and there was a decent enough entry to take. Let's have a look at the next slide. Next slide. Okay, I'm trying to move to the next slide. There you go. So this we've spoken about. So this is what took place that the entry spoke about. So if you didn't take that high low double bottom after MTRA is a major trend reversal, I read one of the strategies that helps us to identify when a market is likely to turn. There is a structure, wedge bottom, failed breakout beneath the wedge bottom. We have a higher low double bottom after which a trend reversal. You can take that. If you didn't take that, you can take that one. If you didn't take that, you can take that. A higher low double bottom, this one, plus we have a breakout pullback high one here. You don't take all three. They're virtually in the same vicinity. You just take one and hold on to it and wait for acceleration up. Yes, yeah, sweet, thanks, good question. The low of bull channel is on the daily time frame. This is on the daily time frame. That's where the channel is. It's on the daily time frame. So we have got a few seconds to go. Let me just go onto the daily time frame there. So on Hang Seng 50, that is the daily time frame. That's the channel that we're speaking about. That's the channel line that the market is breaking. All right, guys, I trust you enjoy. Oh, you can't see my daily chart. Hold on a second before we go. I wonder why I didn't see that. Okay, I'm going to stop sharing and share again. So thanks for pointing that out. So there is a bull breakout, the spike that I spoke about, a couple of candles, bull breakout. And then we have a channel. That is the channel that is controlling the market, bull breakout, pullback, and channel. Now, as far as just price action on this is concerned, The breakout, the measured move is up here. So the measured move of that channel is up here. That's where the bulls want to go. Again, there's another measured move tool we use, the leg one. There is leg one. There is the end of the pullback, and that is that extension belt 100. So that channel line, the bears want to break out beneath that. They have a problem with the moving average, then they want to smash right below that. The bulls, of course, want to contain price within that. All right, folks, thank you very much. I trust you enjoy the Quick Punchy show. We will catch up again next Wednesday. Thank you for participating. Bye-bye.